was the first time you left it on the door?
Because
I guess I talked beforehand. All right, well, we'll pour next week.
I wasn't sure because usually what I do is I wait till the last time I did it was but now that I know it's coming.
Okay, I'll get the earth. I just went up there. There was my quiz wasn't there. No idea why that might be. I slipped it under your door. Yeah. Luckily, I can print it out again if that is an issue. But yeah, I slipped under your door before I left. Coleman, C-O-L-E. Yep.
Okay, let's get started. You know what today is? What's the date today? April 13th, right? The reason I bring that up is your very last class is 4 weeks from today. Your final is 4 weeks and 4 days from today. Your project is due exactly 4 weeks from today. I know some of you, most of you haven't even started on the project. I've been nagging you all along, right? But you know what? The rate of nagging is going to increase exponentially, if that's possible. Maybe I'll start sending you 3 emails a day, text you, notifications on your computer. But get started. I mean, there aren't that many, especially as you get to the last 2 weeks, all kinds of stuff is going to hit your plate. So at least get started. And I'm going to give you actually, you know how, have you ever played Chutes and Ladders? Like, you know, you're way behind and then you get this ladder that takes you to number 93, and if you avoid the snake in 97, you get to 100, you win. I'm going to give you a ladder today. So towards the end of the class, I'll give you a way to get caught up on all of those hard-working group members of yours who've been working all through the semester. You haven't even started. I'll give you an easy way to catch up with them today. I hope you take advantage of it. Right? Your quizzes are also, what's left of them is still upstairs. So I'm going to leave them out for a couple more days, hoping you come pick them up. But if you haven't picked them up yet, my feeling is you don't want to pick them up. But hey, you know what? It's going to sit out there whether you like it or not. So pick them up if you get it. I mean, if nothing else, make sure that I have an added scores up, you know, especially as I get to about 10 o'clock at night and I'm grading. I'm just sometimes on, you know, places I shouldn't be while I'm grading, like falling asleep. So don't assume that just because there's a score in front that I've done everything right. Hey, of course, I know only one type of error is going to come back to me. It's always a problem. So if you've got too low a score, you're going to come to me. If you've got too high a score, you're probably going to sit on it. I'm not going to draw on any moral or ethical. If I screwed up in your favor, keep the favor. Okay? It's okay. I won't think less of you as a human being. You won't, at least as long as you don't think of yourself as less of a human being, I'm okay with that. But pick up your quizzes as soon as you can. So let's pick up where we left off last Wednesday. I know whatever you do after a quiz is always fraught with issues of, are you paying attention because you're thinking about the quiz? So I'm going to go back and very quickly review what we did. We talked about using the cost of capital approach to optimize capital structure. The word optimize is such a nice word. It sounds like you're an engineer or a mathematician. I'm going to steal that word, even though it really doesn't quite fit, because what we do is a lot more uncertain than what an engineer or a mathematician does. And the decision rule is very simple, right? Find the mix of debt and equity that minimizes your cost of capital. And I started the process by showing you that table I was shown in my first corporate finance class for XYZ widget company. And remember what made my class uncomfortable about the table is when you pointed to a number and said, why is your cost of equity 12% at a 30% debt ratio? My response was, I made it up. Just take the story and run. And I promised you at the end of the Disney analysis that I would have a table just like XYZ widget company. And here's my cost of capital schedule for Disney. Okay? So let's very quickly review how I got the numbers I need to come up with the cost of capital. So I looked at debt ratios from 0 to 90%. I stopped at 90 because once, as I said, once you get past 90, you're really talking about debt becoming equity. Equity ceases to exist. I estimated the beta at every debt ratio. Somebody remind me again how I did that? What did I start with? That 0.9239 is the bottom-up beta for Disney based on the 5 businesses they're in. It's a weighted average. And every beta after that is just that unlevered beta levered up using the debt-to-equity ratio. So essentially the business stays the same, but I'm changing the mix of debt and equity. That's why it's called a recapitalization. The balance sheet, I'm freezing the assets out of the balance sheet and changing the financing mix. So as I borrow more money, my beta goes up. As my beta goes up, my cost of equity goes up. But now if you pointed to that 11.48% and say, why is your cost of equity 11.48% at 50%? I should be able to give you the reason, right? Here's my unlevered beta, here's the debt to equity ratio, here's the tax benefit, here's why the beta. You might not like the equation, you might come up with a different one, but at least have a process for estimating beta and cost of equity. The cost of debt was a little messier, right? Because all I knew was the rating that Disney had at its existing debt ratio. So what I had to do actually was estimate the rating at each debt ratio from 0 to 90%. Let's do the easy half of what happened. As my debt ratio increased, my interest expense went up. As my interest expense went up, my coverage ratio decreased. As my coverage ratio decreased, my rating dropped off. And as my rating dropped off, my cost of debt climbed. The one other thing that I brought in was the fact that once you got to a certain debt ratio, in this case about 80% debt, it turns out that your interest expenses exceed your operating income, and I said no more. You can't get any more tax benefits. So the other factor that's changing beyond the 70% is not only is my cost of debt rising, but I'm not getting any tax benefit from it, which is a bad thing. It pushes up my after-tax cost of debt. So there's my after-tax cost of debt. I have those two columns. This one is simple, right? It's just a weighted average of those two. But take a look at what's happening. As I increase my debt ratio, what happens to my cost of equity? It goes up. As I increase my debt ratio, what happens to my cost of debt? It goes up as well. At first sight, you're saying, this is not good. Both my cost of equity and cost of debt are going up. But at least initially, what's happening to my cost of capital? It's actually going down. It's almost magical, right? You have two ingredients. They're both becoming more expensive. You're saying, how does the combination of the two become cheaper? It's because I'm replacing more expensive equity with cheaper debt. That's a trade-off. And initially, the trade-off works in my favor. So I go from 8.07, 7.81, 7.54, 7.33, 7.16. And then the tide turns. Then the trade-off starts to work against me, my cost of capital climbs. So if I gave you this table and said, what's the optimal mix of for Disney? It is about 40% debt, right? Which is a little unfortunate because it's two companies in a row for which I've got a 40% debt ratio. Reason why is that unfortunate? Because people love to form rules of thumb. I remember doing this at an investment bank once. And it was for a re-education camp. Basically, it was for corporate finance bankers with more than 10 years of experience who were brought back for a re-education program because it's very easy to forget the basics of corporate finance when you're doing deals day after day after day. And none of them wanted to be there. They were forced to be there. And one of them was very ostentatious about the fact that he did not want to be there. So it's like it's a one-day program. He came in with a Wall Street Journal. He opened it up and sat there. I have no problem with people reading the journal. It's a good thing to read, but he kept it was the same page for the whole day. At least if you're reading it, change pages. Are you so slow that you can't read a whole page in a day? But it was his, I really don't want to listen to you. So I finished this, and he puts up his hand and said, I have a question. I said, good, this guy has a question. He must be listening behind that paper. I said, what's your question? He said, can we safely assume that the optimal debt ratio for all companies is 40%? Makes your life a lot easier, right? Rule of thumb, 40%. You're below 40%, you should borrow more money. And I had to tell him the truth, which is you cannot safely assume that it's 40%. And in fact, if you do it, I can safely assume that you will not have a job, or your company, or worse, your clients are going to go bankrupt in about 6 months. So let me tell you up front, you cannot safely assume that the optimal is 40%. Sometime very soon, you're going to be computing optimals for your companies. And I'll predict that the optimal debt ratios for the 350 companies in this class are going to range from 0%. There are some companies where it doesn't make sense to borrow any money. We're going to look at why. To about 80%. There will be some companies where the optimal is as high as that. And we'll talk about why those differences exist. But this is pure coincidence at 40%. In fact, if I drew this as a graph, this is what it looks like. First, it's not a U. Notice what happens initially as I borrow money, my cost of capital decreases by small amounts. Especially for mature companies, don't expect large changes in your cost of capital. It's not going to happen. And then you hit the bottom right there, right? Then notice what happens. You hit an inflection point and your cost of capital starts climbing very fast. You know what I see when I see that graph? A red light that says if you're going to make a mistake on capital structure, you should borrow too little money or too much money. I'd rather that you borrow too little money than too much. It's a note of caution that companies should take to heart, because if you get to that inflection point, everything, and this is without even bringing in bankruptcy costs, everything is going to start imploding on you. You want to try to avoid getting as close as you can to that point. So that is the optimal debt ratio for Disney. And this is from the 4th edition of the book. So this is the 4th time I've done it publicly. And the very first edition, actually, of the book in '97, I did the same thing I do now. I haven't learned that much over the last 18 years, so it's pretty much the same thing. And this is what the cost of capital graph looked like in 1997 for Disney. The optimal was 30%. But notice something a little unusual about this graph versus the last one. There's a kink in the cost. It's a kinky cost of capital graph. This Excel spreadsheet that I'm going to give you to use on your company today, that's going to be the ladder you're going to use to climb into the number 93. It's been on my spreadsheet, on my website now for about 20 years, and people download it, they use it. I have no problems with them doing it. They don't even have to tell the world that they're using my spreadsheet. And about 20 years ago, a group of bankers at what was then the First Chicago used to be a standalone bank with an investment bank associated, the Chicago, the Midwestern Investment Bank. A group of bankers started downloading the spreadsheet and using it for their work. I knew they were doing it because I would hear from different people that they presented it to. And I had no problems with it. So one day I come back from a class and the phone rings. And it's the First Chicago banker. He says, I'm calling you from a restroom. He says, I'm calling you from a restroom and something very embarrassing has happened. Call your mother, not me. I mean, it's not my problem. He said, no, not that kind of embarrassing. He said, I'm in the middle of a client presentation. I've used your spreadsheet to draw the cost of capital for my client. There's a kink in the cost of capital graph. What's wrong with your spreadsheet? It takes a lot of gumption. To download a spreadsheet for free, use it for commercial purposes, and then turn around and ask me what's wrong with your spreadsheet. I was in a good mood that day, though, so I told him, and you can probably tell him too. How do I compute the cost of capital at every debt ratio? I take a cost of equity and a cost of debt. I'll give you a clue. When you get a kink in the cost of capital, it's because something is moving discontinuously. You know what I mean by discontinuous? It doesn't change, jumps. So think about the two ingredients. What do I do to get my cost of equity? I get a levered beta, right? So even if your debt to equity ratio changes by a little bit, your beta will change and your cost of equity will change. How do I get the cost of debt? I compute an interest coverage ratio, then I go to that lookup table. You see what could happen? If your interest coverage ratio doesn't change enough, I might leave your rating where it is as you go from 50% debt. It's completely unrealistic because you could be double B rated and have a low double B rating, or the markets can discriminate. But because I've given you that notch, so basically what will happen is you go from 30 to 40% debt, your rating will change, and you go from 40 to 50, it'll change a lot. Therein lies the king. I said, that's what's going on. The guy wouldn't give up. He said, can I make it go away? I said, it's easy. There are one of two ways you can make it go away. One is, remember, these are synthetic ratings, right? I've made them up. There's no reason why I have to go AA plus, AA. I can go AA plus, 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 plus. The more I break up my ratings, the less likely it is that I'm going to have this problem. So I suggested that he do that, have a lookup table. He said, that sounds like too much work. I said, okay. I'll give you another way to do that. Why do I need a rating? To get a default spread and cost of debt, right? What if I could bypass the entire ratings process and connect my interest coverage ratio directly to my cost of debt? Because we know lower interest coverage ratios go with higher default risk. He said, if you can do that, then, he said, that sounds too complicated. I said, okay. Where's your optimal for your client? He said, about 20%. I said, where's your kink? About 60%. I said, what happens if you make the kink go away? What's your optimal? He says, still 20%. He says, well, why are you freaking out about a kink at the 60% debt ratio if it's not changing your conclusion? So what I'm preparing you for is when you do this for your company and you see a kink at a 50, 80, 90% debt ratio, it's not worth losing sleep over it if it doesn't affect your optimal. And there's a reason it's happening. It's because of the way we estimate cost of debt. So it's not a flaw in the model, it's a flaw in the mechanical process we use to get cost of debt, and it's really not a big deal. Any questions? Yes?
Do I have to repeat this analysis depending on the country that I choose to borrow in?
Okay, the question is, do we have to repeat the analysis in the country you choose to borrow in? So you're a multinational, you can choose to borrow in 11 different countries, in the same currency or different currencies?
Different currency tax rates and
Okay, let's make it very simple. You have a choice of borrowing in 11 countries with the tax. So first, if the currencies are different, you can't compare the rates at which you can borrow, right? Because obviously it'll be cheaper to borrow in Europe than in Indonesia. So first you got to clean up for that currency difference. Otherwise, so let's say you cleaned up and you have 11 countries in which you computed a dollar equivalent cost of debt. So first step. You want to borrow in the country where you can borrow at the lowest rate, or the country you borrow at the highest rate? Lowest rate. First, remember, you get to pick where to borrow money. You want to borrow in the country with the lowest tax rate or the highest tax rate? Guess where you're going to borrow your money. You want to borrow in the country with the highest tax rate, with the lowest cost of debt. If you're a multinational, you're probably either going to borrow in the US or Germany. You're not. It becomes very simple. It's not as if you have to spread your debt out in 11 countries because you have operations in 11 countries. You can choose where to borrow money. But he's saying that violates that financing principle, right? Don't mismatch your debt. That's easy enough to fix, right? If you have a lot of dollar debt and you have a lot of rupee cash flows and you want to maximize your tax benefit, you can buy forwards or futures or whatever you need to do. This is one of those cases where you use the long way to match your debt, where you borrow in the wrong currency, knowing it's the wrong currency because you want to maximize your tax benefits, and then you try to fix it. Guess where Apple has all $50 billion of its debt? I mean, it's a multinational, right? It's got all this trapped cash, all this income from other countries. All of Apple's debt is in the US. And it should be. It makes no sense for Apple to go borrow in Ireland because what's it going to do with that interest expense when your tax rate is 12%? So here's what I'd like to do next. We've come up with an optimal, but it's just a number, right? In fact, what we're suggesting that Disney do is pretty momentous. Right now, Disney has about $16 billion in debt. That's their existing debt. We're asking them to increase their debt from $16 billion to $55 billion. That's what 40%. So first thing is I want to make that debt ratio, that's this percentage, into a number. So basically I want Disney to add $39 billion. But that's not all. What do I want them to do with this $39 billion that they borrow? What do we say we want companies to do to keep this process clean? They have to buy back stock or pay a special dividend. So I want Disney to borrow $39 billion and buy back stock or pay a special dividend. Huge, right? And if Disney has any sense, there should be 3 questions they need to ask me. And these are 3 generic questions you should ask anybody who asks you to borrow a lot of money, whether you're an individual or a corporation. First, why should we do it? You think that's easy. The cost of capital decreases. You're going to see it's not a very effective sales pitch to say your cost of capital decreases because it's going to look completely disproportionate. Second, what if something goes wrong? See what I mean by what if something goes wrong? You have a great investment banking job, you borrow $200,000. What could go wrong? Well, you might not have a great investment banking job a year from now, in which case you still owe $200,000. And the same thing can happen for companies. You borrow in a good year. What happens if next year you have a horrible year? You borrow based on the fact that your last movie was Frozen. Well, your next movie can be The Lone Ranger again. Things can change. So what if something goes wrong? Sensible question to ask.
Wouldn't the beta capture all of that?
The beta will capture the variability in earnings, right? But you're worried about truncation risk. You know what I mean by truncation risk? Which is you can have a really good-looking cost of capital, but if you're not around to take advantage of it because you ran into a debt problem, everything else unravels. So what if something goes wrong? In fact, both the beta and the cost of debt, we're trying to be sensible and adjust for expected risk. But this is unexpectedly bad news. And third, I'm asking you to buy back stock. There are still portions of the world where you're not allowed to buy back stock. There are either legal restrictions on companies buying back their own shares, or there are book value restrictions. You know what book value restrictions are? Your book value of equity is not allowed to go below 0 in much of Europe. So once you get to that, you're stopped. Because the accountant says your book value of equity goes to 0, you can't do any more buybacks. And if Disney bought back this much stock, their book value of equity would go negative. So what if you don't want to buy back stock? Can we take projects instead? Do you see why companies are going to have this question? If you're an ambitious, high-growth company, and I've just told you you have debt capacity, the last thing you want to do is borrow money and buy back stock and then have to raise fresh capital for those next investments. It would be a marriage made in heaven if you could bring the two together. So let's take each of those questions. Let's start with the first question. Why should we do it? The answer seems simple, right? Because if you do this, your cost of capital, which right now is 7.81%. So let me go back to that table. 7.81%, that's roughly where we are, will go to about 7.16%. You see why, though, this is not going to be a great way to pitch this? What am I asking you to do? Borrow $39 billion and buy back stock, and if you do it, your cost of capital will decrease by 65 basis points. That actually makes it bigger, sound bigger than it really is, by 0.65%. You're saying, you want me to do what to get what? And that's always going to be the case with big companies, is cost of capital are not going to move very much. So what I'm going to do is I'm going to take the change in that cost of capital of 65 basis points and make it real money. Might not work for you, but at least you can see what you're leaving on the table. So here's one way to do it. The cost of capital, as we've talked about it so far, we've talked about it as a hurdle rate, right? But we also said the cost of capital is the discount rate used to value an entire business. You take the cash flows to the entire business, you discount it back at the cost of capital, you get the value of the business. I'm going to draw on the second use for the cost of capital. I computed the cash flows to Disney as a company. You're saying, what the heck is that? Exactly the same way we compute cash flows to a project. After-tax operating income plus depreciation minus change in working capital minus capex, but for the whole company. I got about $3.66 billion as the cash flow to Disney. So that's the cash flow to Disney last year. I know the market value of the firm right now, right? The total value of the firm right now, if I add up the market value of equity and debt, is about $133.9 billion. You're saying, where are we going with this? I know the value of the company, I know the cash flow. The existing cost of capital is 7.81%. The only thing I don't know is what growth rate the market is anticipating, and I solve for that growth rate. So basically that's the existing market value of the firm, cash flow, cost of capital, I'm solving for the growth rate. Okay? That growth rate that I get is called an implied growth rate. Basically I'm backing it out of the value of the company. And the growth rate that the market is forecasting is about 4.9%. So here's the last step. I have the cash flows, I have the growth rate. I'm going to replace the 7.81% with the 7.16, which is what my cost of capital will be at the optimal. I revalue the firm with a 7.16% good. It's magic. My value, which is 133.9 billion, if I replace it with the 7.16%, jumps to 172.9 billion, which sounds too good to be true. By just changing the debt ratio, my value as a company increases by 39 billion. And it's probably too good to be true because here's the flaw. I'm assuming a growth rate of 4.84% forever. In an economy, if you think about the risk-free rate and the nominal growth, is probably closer to 2% to 2.5%. So I'm probably overstating the increase in firm value. So here's a shortcut that you can use. One way to think about the cost of capital is what it's costing you to fund the entire business today. So if I asked you, what's your annual cost of funding your entire business today? If you took the market value of the business and multiplied by the cost of capital, you come up with a cost of financing the business. An annual cost. It's a very strange cost. It's not like you're paying anybody explicitly because much of this is equity, which is an implied cost. But if I go from my 7.81 to 7.16% cost of capital, I save 866 million. You think, who cares? It's a $133 billion company. You're saving 866 million in 1 year. This is a permanent change in my cost of capital. I'm going to save that, in a sense, in perpetuity. And here I'm going to impose the rule that my growth rate can't exceed my risk-free rate because that kind of keeps my valuation in sync. And I get an increase in value of about 19.6 billion. I think that's a much more realistic assessment of what will happen to Disney's value if it goes to a 40% debt ratio. So when people talk about leverage transactions and how leverage adds value, this is what they're talking about. Hey, by doing this. But let's be brutally honest about where this increase in value is coming from. Remember, Disney is taking exactly the same projects it did before, right? Same theme parks, same movies. All that I'm changing is the mix of debt and equity. So where is this additional 19.6 billion in value that I've just created? It's like financial alchemy, right? Remember the old alchemy stories where people kept trying to change things into gold? It looks like it's magic. I've done nothing to the company. But there's probably some law in physics which is similar. You can't create value out of nothing. When you see value show up, it's coming from somewhere. Where is this extra $19.6 billion in value coming from when I change my cost of capital? You want to try? Where is it coming from? No?
The tax savings, the government.
That's why it's good to be brutally honest. It's coming from the taxpayers. When you claim to be an LBO guy and you tell me how much value you keep creating, let's be absolutely clear. You're not creating value, you're transferring value. Doesn't make you a bad person, you're just playing the game the way the rules were written. You've transferred value from taxpayers because effectively it's coming entirely from the taxpayer. In fact, a little later in this process, I'm going to change the tax rate to Disney to 0. Guess what happens to the optimal debt ratio then? Don't take too long. It goes to 0. You say, what if I have a lot of cash? It doesn't matter. You think, but isn't debt cheaper than equity? It doesn't matter. I don't know how many calories are in a glass of milk. Somebody probably does. But if you take that same milk and you make it into skim milk and butter, guess what? The number of calories in the skim milk plus the butter is exactly the same as the calories in the whole glass of milk. You're saying, what's that got to do with debt and equity? You take a firm. The firm's value comes from the investments you make as a firm. If I don't have the skew in the tax law, changing it into debt and equity is like making it into butter and skim milk. The butter being the equity and the skim milk being the debt. But you can't change the value of the firm from nothing. So there is an increase in firm value, but I think it does make sense to step and ask, why is that happening? And if you are looking at what, and this is the one thing that I think is troublesome about restructuring in the US for the last 30 years. To me, there's good restructuring, which is you go fix the operations, you change the way you do businesses. That's value creation. Then there's this value transfer restructuring, which is from changing your debt ratio and increasing the value. And if the bulk of the restructuring is value transferring restructuring, the entire economy can't benefit from this. You might have a shift of wealth, but you're not creating value. And that's, I think, something we have to confront. And the blame for that lies entirely and completely on our tax code. I think if you want to fix this, you've got to change the rules of the game. You can't have the game be tilted towards debt and complain about the fact that people keep taking advantage of the rules as they're written. You don't like the outcomes, you got to change the process by which we get to those outcomes. Yeah.
Is there a specific reason why there's a consensus internationally that interest expense has to be tax deductible?
That's a good question. Where did this come from? Because every religion, as I pointed out, says don't borrow money. But about 100 years ago, people started writing tax codes. And let's face it, corporate tax codes are about 100 years old. Because before that, there were no corporations. What is it that you think drove this, created this drive towards giving debt an advantage? It's actually, think back, 1915, you're writing the tax law. Most of the companies you're looking at are what? Railroads and oil companies, and you want them to grow fast. Remember, 100 years ago when the tax code was written, equity markets were nascent, they were small. So if you wanted to raise capital in equity, it was really tough, even if you're a big company. So if you're a politician, you want growing economies, right? And if you want growing economies, we have to make it easier for companies to raise capital. And when the tax code was written, so let's make it easier for them to borrow money because that way they can raise capital. The notion of raising equity then was not really on the table. But you think that was 100 years ago. Why haven't they changed it yet? Once you put something into the tax code, God help you if you try to take it out. Before you complain too much about companies taking advantage of this, and if you own your own apartment, nobody here. It's all equity funded, or you've taken a mortgage loan on it? Two mortgages. Sensible guy. Housing is the most tilted asset class of all. We've created huge tax advantages to borrowing money to buy your own house. And again, the intentions were probably good. We want homeowners, not renters. Let's make it easier for people to buy their own homes. So therefore, if you borrow money to buy a house, we're going to allow the interest as a tax deduction. There are these tax proposals going around that says, let's take away that mortgage deduction. There is zero chance of that happening because an entire ecosystem is being built around those mortgage loans, right? You got financial service companies that lend money on mortgages. You got realtors who sell more houses because of those mortgages. You have homeowners who could not afford to be in the house they're in right now without the tax benefit. It's almost like you got to arrange a transition for that to happen. But once you get bad stuff in the tax code, it's very difficult to get that stuff out. So the original rationale was probably set in a very different world, in a very different market, with the best of intentions, and we're stuck with it. Right? So that's the rationale. So now let's make it, they take it to the next level of what to do next. So let's say that I've convinced you that this is good. You as Disney should go out and borrow $39 billion and buy back stock. Now, what does that mean to buy $39 billion worth of stock? How exactly do you do it? You could sneak into the market a little at a time, but that's actually both illegal and very impractical. We're not talking about 39 million, we're talking about 39 billion. You actually have to do a tender offer for your own shares. Take a full page ad and offer to buy back shares in Disney. So let's play a game. You're all Disney stockholders. I've decided I'm going to buy back shares. You all see what's going to happen, right? After I buy back the shares, the value of the company is going to increase by 19.6 billion. The stock price at the time that I did this was $67.71. Okay? So you guys are going to sell your shares back. You guys are going to stay on in the company. If I want a fair transaction, you know what I mean by fair transaction? Both the people selling their shares back and the people who are left in the firm get exactly the same share of the spoils. Spoils here is 19.6 billion. The solution becomes surprisingly simple. I'm going to take the 19.6 billion and divide it by the total number of shares outstanding. You see why total number of shares? Because I want everybody to get an equal share. And if I do that, my value per share is going to increase by $10.90. So I'm going to go buy shares back from you at $78.61, $10.90 higher than the price before. And you guys are going to be okay with it because the remaining shares are also going to be worth exactly $78.61. I call this the rational solution because in a sense, any other solution, one side is going to be pissed off and the other side isn't. And the side that's pissed off has no right to be pissed off because they chose to be on that side. You see why it's chosen? You get to decide which side. So when somebody says, I own shares in a company, they're buying back shares at too high a price, your response is, sell your damn shares back. Don't keep complaining to me. There's an easy solution. And if you're not a shareholder, it's none of your business anyway. Get out of here. So when people complain about companies buying back shares at too high a price, my first response is it any of your business? If you're not a shareholder, get the heck out. You have nothing. This is an intra-company fight. And if you're a shareholder, do something about it. Join the right side as you see fit. Question?
That 19.6 billion
Yep.
in added value, isn't that coming from the enterprise value, not equity value?
That's true. And that's actually a good question. I'm assuming, first, to get to that 7.16% cost of capital at the new debt ratio, what did I do? I adjusted my beta. I also adjusted my cost of debt to a fair interest rate, right? So that 7.16% reflects the fact that when I borrow money, I'm paying a much higher interest rate in all of my debt. So the debt holders are already being taken care of through my cost of capital. All of the surplus now belongs to the equity investors because of the way I constructed the cost of capital. Okay? So just to show you what's going to happen if I'm not fair. Let's assume I could buy the shares back at the old price. That'd be incredibly stupid of you guys to do, right? Sell the shares back at an old price. But let's say you guys are desperate for cash. You guys should be delirious with joy if I can do this. Because if I can buy the shares back at the old price, here's what I'm going to do. I'm going to buy the shares back at the old price. And because the old price is lower, the number of shares I buy back will be a lot. The remaining shares, which are owned by you, now get to keep the entire 19.6 billion. So here's what I want you to remember. With the rational amount, you were making 1090, right? If I can buy the shares back at the new price, I'm sorry, 67.71 at the old price, basically what I'm going to be left with is 1,221 million shares. If I divide the 19.6 billion by that, the value per share that I get is $83.78. You get almost a $16 increase in the stock price if I can buy the shares back at the old price. So if you're the stockholders who plan to stay in the firm, you want me to buy back shares at a lower price rather than a higher price. Now, if you're a manager, you have two groups of people here, right? The people who are going to sell the shares back, and what's going to happen to them after tomorrow? They're gone. And the people who stay on, your loyal long-term stockholders. Who would you rather cater? If you're going to be unfair to a group, which group would you rather be unfair to? Just think from a personal standpoint, from a selfish standpoint as a manager. I'd rather be unfair to the people who sell their shares back because it's a voluntary transaction. But here's one of the great tragedies in buybacks. When buybacks happen, the complaint is not usually that the buyback price was set too low, it's that it's set too high. Because think of why. If you hire me as an investment banker and you pay me an underwriting commission to buy the shares back, it's much easier to buy shares back if I set the price too high than too low. And the fact that there are people who are hurt doesn't matter to me. I'm not a shareholder. I'm just a deal maker. So if I pay $85 per share instead of $78.61, guess what? You guys are going to be delirious with joy because you got $17 per share. You will get a much smaller amount. And that's the thing to think about in buybacks is you have winning teams and losing teams. And if you're a shareholder, don't be a passive onlooker. Join the winning team. There aren't too many chances in life where you get to pick, right? But in this case, you get to pick which side you want to be on. In fact, to just show you that the $78.61 is the rational price. If I bought the shares back at $78.61, I'll have 1.3 billion shares outstanding. You divide by the remaining value of equity, the value per share that you get as the remaining stockholders is $78.61. That is what makes it a rational price, is everybody should be able to walk out of this room and none of you should say, I got gypped. Okay? But to do this, you have to go through the process of computing the increase in value and figuring out how much you should be willing to pay. Any questions on why should we do it? So it's not the 63 basis points or the 0.65 or the 65 basis points. It's if you do this, you're going to increase your value by 19.6 billion. And unstated there is you're increasing your value because you're taking advantage of the tax law. And your value per share is going to increase by 12%, 15%, 18%, depending on what you started with. So that's the first question. Second question, what if something goes wrong? If you're ever asked this question, let's say you do this for a living, compute the optimal capital structure for a company. If you're ever asked this question, here's the one answer you should never give, which is nothing will go wrong. It's almost like you're tempting fate. Before you walk out of that room, something will go wrong. So whenever I'm asked this question, because I sometimes do this for managers, and I turn the question back on them. So what is it you're worried about? And the answer you get will be different. If you're a cyclical company, what is it you're most worried about? You're a retailer or a steel company. What if there's a recession? If you're a company that is a defense contractor, what if there's a cut in the defense budget? If you're a company that gets 80% of your revenue selling to Walmart, you're concerned about what if I lose that contract? It's good to know what people are afraid of. And if you know what they're afraid of, here's the way you can deal with it. Bring it into the analysis. Because what are they worried about? That their income will drop off. And if their income drops off, they might not be able to service the debt. Bring it into the analysis and see what happens. In fact, I'm going to give you a couple of ways in which you can work this through. One is you can do what-if analyses on the operating income. See, what if that happens? What if there's a recession? What if there's a downturn? What if I lose that contract? Bring it in the operating income, compute the optimal. And if you're worried about scenarios, you're doing an oil company, you know what every oil company is worried about right now, right? What if oil prices stay at $40 a barrel? Or worse, still drop to 25? Again, you can do the scenarios. Oil price 25, oil price 40, oil price 65 to see if in fact your optimal is very sensitive to those changes. The other way you can build in a buffer is, I told you Disney's optimal was 40%, right? Why? Because their cost to capital is minimized. I never mentioned what their rating would be at a 40% debt ratio. All you know is it's much low. It's going to be lower than today's rating. This is not the case. But what if Disney's rating had dropped to double B at 40%? It still has the lowest optimal, but as a company, might that hold you back that you dropped to double B? What's the magic line that companies don't seem to want to drop under? Investment grade, which is triple B, because we'll talk about why, but there seems to be, most companies have a rating constraint, and one reason they put a rating constraint is to prevent that unraveling of things if bad things happen. So I'm going to try both on Disney. To see what if something goes wrong, to answer what if something goes wrong, I had to get a sense of what will happen in a bad year to Disney. You see, that's pretty stupid. We know what happens in a bad year. Their income drops, but by how much? I'll give you a contrast. You know what a bad year for Con Ed looks like? About a 10% drop in operating income. Because they're a regulated utility, they can pass everything through. A bad year for Dell might have been a 50% drop in operating income. So the first thing I want to do is look at a company's history to get a sense of what a bad year looks like. And for Disney, I went all the way back to 87. And here's, every year I just computed the percentage change in operating income. Nothing magical, I'm just saying, what's a bad year? How big a drop? The worst year that they had in this period was a 29.5% drop in 2000. I don't even know what happened. Okay. But I don't care. Bad things happen, and that's revealing because that was their worst year. Do you see why this is helpful to know what it was? So some of these companies, worst year might be an 80% drop, but here it's 29.47%. I wanted to also see what happens during economic downturns. So I took 81, 82, 91, 2002, 2009. And in three of those, you see drops of 22, 16, 23. So I'm getting a sense of this is what a bad year, a 20%, a 25% drop in operating income is a bad year for Disney. Yes?
Is this normalized for divestitures?
It's normalized for nothing. So in a sense, if a company does a lot of that stuff, you're going to get bigger swings in the operating income. And if you get bigger swings, you also want to build a bigger buffer because odds are they're going to continue to do the kinds of things that cause the shifts. You can go down to levels of detail and see what's causing the drop, but you really care about at the aggregate level what this drop is going to look like. Now, why do you think Disney is a little buffered into why isn't the drop huge for Disney? in 5 businesses, right? The theme park business, so in a sense is that you take Lionsgate, which is an entertainment company. Right now they're on a boom. Why? I call it the Hunger Games effect, right? The Hunger Games are creating huge revenues, and even if they create one every 2 or 3 years, it's going to keep them going. But you look at their history, they've had 80% drops in operating income. Because you go from having a successful movie to no successful movie, and that's all they have is 1 movie or 2 movies a year. So depending on your company, you're going to have to ask different questions about what's a bad year going to look like. So in this case, here's what I did. Remember again, bad year is about 20 to 25%. I dropped the EBIT by 10, 20, 30, 40, 50, 60% would be a catastrophic year for Disney. That's twice as bad as the worst possible year in their history. Okay? But even if I drop all the way down to 30%, which is worse than their worst year in the last 26, their optimal stays at 40%. What does that tell me? It tells me that Disney has a pretty big buffer built into their operating income, that even if they go to 40% and they have a bad year, they're going to be okay. I do this because often when companies don't borrow money, it's because managers have a visceral fear of debt. And don't underestimate, there are companies where managers are terrified of borrowing money. Why? They say, what if something bad happens? Do this assessment for them, and maybe they're right. Maybe small changes in their operating income will make their optimal disappear. But if you can drop their operating income by 50%, 60%, and they can still borrow money, you've taken away that excuse. They might still choose not to borrow money, but at least let's be honest about why they're not borrowing money. It's because managers are uncomfortable with debt. It's not because it's not going to work for this company. So in this case, even dropping big amounts, dropping the operating income by big percentages doesn't change my optimal. Yeah.
But don't you think you should reflect on this a little bit? Because if there was a 50% drop in operating income, that would be income before interest. Let's imagine you borrowed this money, the
Right.
39 billion. If you got a 50% drop in operating income, you then have to pay a shit ton of interest.
You're going to pay the interest expense you promised up
So your
front.
net income is going to be doubly negative. At that point, you're at the double B rate.
No, wait. It can't be negative because remember, if my optimal is staying at 40%, the way I compute interest coverage ratio is I look at your EBIT divided by interest expense.
Right.
So the EBIT is clearly not dropping that much because my...
It's dropped 30%.
But the fact that my optimal, remember the way I compute the optimal is I do the cost of capital at each debt ratio, which incorporates the cost of debt. So if my operating income were actually, even though it's dropped by 40%, the operating income there was about 10 billion. 40% drop on that is 6 billion. Which is, so if they have 6 billion in operating income, the interest expense I have on their debt with 55 billion is about 3 billion. So it's true, the net income will become lower, but it's, see, that's the reason I want to do the full optimal. If I dropped it by 40%, their operating income actually dropped below their interest expense. The rating would go to C, the cost of capital would explode, their optimal would shift all the way down to 10 or 20. That's not happening, and that's revealing here because a 40% drop in operating income is still not going to put them, forget about distress, it's not even going to drop their rating below triple B. They have enough buffer built in. That's not going to be true for every company. In this case, it looks like they have enough buffer built in. So that's something to think about, and all you're changing is the operating income because that is the key number. This is an income-driven approach to debt capacity. If you don't have the income to service the debt, I'm not going to let you borrow money. You could be a large company, lots of assets, I don't care. You need income to service debt, and I want to make sure you have enough income to service the debt. Here's the second thing you can do. So what if you have a rating constraint? Almost every company I've ever talked to has a rating constraint. As I said, the most common one is that investment grade. So let's step back and ask, what's so special about an investment grade rating? What happens to companies that fall below investment grade?
Pension funds and other investment vehicles can't invest in.
First is there might be some investors who can't invest in your company because you're below investment grade. So it might reduce the demand for your shares and your share price might drop. Okay, that's one. What else? First, it's much more difficult to borrow money. It's not impossible. Pre-81, it used to be impossible. You say, what happened in 81? What happened in 81? I'll give you a clue. Drexel Burnham and Mike Milken, essentially they created an original issue junk bond market. Junk bonds have always existed. They didn't create junk bonds. But what they allowed was companies that were below, but it's more difficult to access capital.
Commercial paper, yeah.
And so there are portions of capital. What else?
Dropping rating signals to the investment universe that there's something wrong with the company, so their stock price.
Which is but I'd say it's not the investment universe you should worry about. What happens the day after the rating drop? What do you see? A news story in the Wall Street Journal, right? XYZ company's rating drops below investment grade. Next thing that happens, your suppliers are calling you, saying the next supply we'd like to be paid in cash, in small bills, in a big brown paper bag if need be. Right? Your customers are holding. In other words, that indirect bankruptcy cost thing starts spinning out of control. So there's a good reason for an investment grade. So if somebody says, I don't want to drop below investment grade, I get it. I'll respect that. Even if they say single A because I want to have some buffer, fine. But once in a while, you will have a management that's completely and totally stuck on, we want a AAA rating at any cost. Rise to the challenge. Give them the bill. I'll give you a story for this. About 15, 20 years ago, I was talking to the CFO of a European steel company. It was the last AAA rated steel company in the world. So I asked him, what is this fixation you have? Because that's all they talked about, is how they were AAA rated, how great this was. So what is this fixation you have with AAA ratings? And he said, it's obvious, we can borrow money at a really low rate. I said, how do you maintain your AAA rating? And he told me. He said, we never borrow money. This is the kind of circular logic that gets companies into trouble. So the only way you maintain this capacity to borrow money at a really low rate is by never borrowing money. I'd much rather you took a AA rating and actually borrowed money. So in fact, when you're given a rating constraint, here's something you can do. Remember that spreadsheet where I had the cost of capital at every debt ratio? Let's assume Disney told me that they wanted, at a 40% debt ratio, I'll concede to you, Disney's rating drops to single A. Their current rating is AA. So let's say they told me, look, we want to maintain that AA rating. We can't, no, for whatever reason, we can't let it go. Here's all I have to do. Take that table, look at the cost of capital with a constraint, which is I want to pick the lowest cost of capital subject to the constraint that the rating is AA or higher, which means I can't go all the way to 40. I have to stop at 30% because at 30% my synthetic rating is AA, but once I get past 30, it starts to drop off and they don't want that. You're saying, so what? A constrained optimal can never give you a better answer than an unconstrained optimal. This is a complete tangent, but last week I got a call from somebody, because right now, you know, there's this big move in universities to divest endowment funds of fossil fuel stocks. So the question was, the person who called said, we're looking at some studies that show that your returns can actually be better without fossil fuel stocks than with. And I said, how can that be? I mean, you can look at the past, pick a slice of history. Last 2 years, obviously. Having no oil companies in your portfolio would have been better than having oil companies. But how can you end up with a better portfolio if I take 50 stocks out of the 500? I mean, think about coming up with the best portfolio for you. And I give you 500 stocks, and you pick the best portfolio. Then I took 50 out of the 500 out. And I said, pick the best out of the 450. You can never be better off. You think, are you telling me that we shouldn't? I said, no, nothing of the sort. I'm saying, if you want to divest fossil fuel stocks, be realistic about this. It's going to cost you money. But morality does cost money. I mean, that's okay. If you can be both moral and make money, that's great. Okay? But if you want me to be moral and ethical, and you say it doesn't cost me money, you're trying to get the best of both worlds. At least let's be realistic about what you're doing. You're taking stocks out of my universe, and that's okay. But you can never tell me that a constrained optimal is going to give me a better solution than an unconstrained optimal. And the same thing applies here. At a 30% debt ratio, my value is $147.8 billion, which is $5.7 billion less than what I would have got if I'd gone to the unconstrained optimal. So the way to phrase this is, if Disney's manager said, we want to maintain a AAA rating, I'd say, that's fine. It'll cost you $5.8 billion. And that might be okay for them. They might say, look, we valued enough. But if they said we wanted a AAA rating, I'd have had to stop at 20. And the cost, it's really not that they're paying, that their stockholders will be paying, will be roughly $12 billion. It's one way in which managers can be made aware of constraints they throw into the process. And you can take any constraint and price it in here. He said, this is what will happen if I throw that constraint in. So why should we do it? About 19.6 billion. What if something goes wrong? At least in the case of Disney, there's enough buffer here that you're going to be okay. There's enough there. You don't want to go all the way to 40, stop at 30. You still have enough debt capacity. So this is not about pushing you to the maximum you can get to. Maybe you can stop at 30 because there's an inflection point. So what if we don't want to buy back stock? Disney has big plans. It wants to build new theme parks, I think one in Beijing. It wants to make more movies. It wants to expand ESPN. It wants to do all this stuff. It'd be neat if they could take this debt capacity and use it to take projects. So let's suppose the question I asked was, will my optimal be different if instead of buying back shares, I took investments instead, built more theme parks, movies, etc. I'll give you the easy answer first, and then we'll look at the more complex problem. The answer is no. Your optimal will stay exactly the same as long as you stay in your existing businesses. What does that mean? Remember we broke Disney down into 5 businesses. We had proportions in each. If you stay in those existing businesses, everything scales up. So that 40% debt ratio will still hold, but it'll be 40% of a much bigger firm. So if your plan is more theme parks, I'm okay. You can use the debt capacity to do it. But let me give you an alternative. What if Disney wants to borrow this money and buy Twitter? Do you think your answer might be different if they decided to do that? In what direction? What's going to happen? Is the optimal going to decrease or increase if they borrow the money to buy Twitter? What's the characteristic of Twitter as a company? Money making or money losing? Money losing. Negative cash flows or positive cash flows? Big negative, because in addition to losing money, they have growth that they have to fund. You add a money losing, high growth, high negative cash flow business to yours, guess what? Your optimal debt ratio is going to decrease. So you can never give a blank check to companies saying you have excess debt capacity, do whatever you want. If you're planning to do something with the money, I need to know. Not in specific, but at least rough detail. What businesses do you plan to expand in? Because then I can bring it into the analysis. This is what your optimal will look like if you go into these businesses. So these are those 3 questions. Be prepared for them anytime you work with capital structure. Why should we do it? What if something goes wrong? What if instead of buying back stock or paying dividends, we wanted to expand instead? The answers are pretty straightforward. So now let me take what I've done in Disney. But rather than go through in detail, I did this for all of my other companies. With each one, I'm going to focus on, the mechanics are going to stay exactly the same. But I want to focus on what's different with each one. So I took exactly the architecture I used for Disney and applied it to Tata Motors. Remember, it's an Indian automobile company that's part of a family group. Keep that in mind, because when I do the optimal, here's what I did. I did my beta, every debt ratio, very similarly to how I did Disney. I had a synthetic rating. The one thing that I did differently when I did cost of debt is because these ratings are synthetic, I also added the country default spread on, because you're an Indian company, you're borrowing money, that's going to be built in. So notice that the tax rate starts to decrease after 60%. They get to a point where they don't have operating income to cover their interest expenses. Cost of debt, cost of capital. So if I go by the cost of capital, their optimal debt ratio is decreases, then it starts increasing in 20% debt. They're actually at a 29% debt ratio. It looks like they're over levered. But here's the complicating factor. They're part of a family group, the Tata Group. In fact, I did this for Tata Motors, Tata Steel, Tata Chemicals. 3 established Tata companies. They were all over levered. They had too much debt. Then I did Tata Consulting Services, which is actually Tata's biggest company. It's a technology company, which has a debt ratio of 20% but borrows no money. You think, so what? You're a bank in Mumbai. The CFO of Tata Motors comes in to borrow money. You're lending money to Tata Motors, right? But you see the name in front, Tata. What are you lending money on? You're lending money to the company, but you also are thinking about that if they get into trouble, what will happen? The group will step in. It's a very dangerous reason to lend money, because there is no explicit legal requirement, but it's like lending money to the wayward son of a wealthy merchant. The guy is a horrible business person, but he knows that his dad will step in and pay his. You can lend money to him at a really low rate. Here, take more. You want more? Don't stop now, and we'll keep lending you money. It's what happens with family group companies. And what that effectively means that when you have a family group company, as some of you do, don't be surprised to see a strange debt ratio in either direction. Not because the company is being irrational, but because the group is setting that it's intra-group subsidy. It's a problem with intra-group transactions in general. It's an intra-group subsidy you're getting because you're part of a group. And that's driving how they borrow money. So that's a Tata Group example. Again, much of the rest of the process looks exactly the same. Then I switch to Vale. What's Vale's biggest issue? It's a commodity company. You think, so what? Even if you're a mature commodity company as Vale is, your income is going to go up and down depending on what happens to commodity prices. So when I do the optimal, here are the choices I face. I can take the last 12 months of data, saying that's what I have, just like I did for Disney. But that's a very dangerous game to play with commodity companies, right? Because the last 12 months could be a really good 12 months, really bad 12 months. So here I looked at an average across 3 years. And my optimal, if I compute based on the average, is 50. But if I base it on the current operating income, it's 30. And the reason that matters is right now they're at a 35% debt ratio. If I compare it to what they can borrow based on their existing income, they're over levered. If I compare it to what they can borrow based on average income, they're under levered. And here's one of the dangers of borrowing based on average income. If I were advising Vale, this would have been about a year ago, and I used the average income, I'd have told them to go out and borrow more money, right? You know what's happened to iron ore prices since I did this? They've gone down another 20%. So today when I do Vale's optimal, it's down to 20% and dropping. And with commodity companies, and this is exactly the problem oil companies are facing, is many of them are not just over-levered, they're getting more over-levered by the day. And unless oil prices bounce back, about a third of all oil companies, and we're talking about the small, we're not talking about the big integrated oil companies because they're all actually very lightly levered. The Conoco, the ExxonMobil have 3% debt, 4% debt. We're talking about the mid-size and the smaller oil companies, and many emerging market oil companies are borrowed up to the gill based on $80 oil prices. They were already at their optimal or higher at an $80 oil price, at a $40 oil price. They can't survive for very much longer. And that's why you're starting to see bankruptcies start to kick in. You can delay the process for a while because wait a little while, oil price will go up, wait a little while. At some point the banker says, I'm not waiting a little while. It keeps dropping the longer I wait. So you're going to start to see a lot of bankruptcies here. And that's something, again, you want to keep in mind when you borrow money as a commodity company. You don't want to borrow money on a peak year, no matter what people tell you about, hey, this is it, this is the way things are going to be. You want to think about what those prices will look like in a down year. And that's exactly what we're facing now. Yes?
So earlier when you were talking about buffers that hinged on the concept of taking debt.
This one, the average wouldn't have given it to you. Here's what, that's actually a good question. For buffers there, I said go back and look at last 5 years, last 10 years. Last 10 years look really good for oil companies. You'd have to go all the way back 25 years before you start to see the kinds of prices we're seeing now, which for commodity companies is actually an interesting thing because cycles in commodities last really long periods. And if your oil company's been around only 7 years, you might want to draw on the collective experience of oil companies to see how much you can borrow. It's not going to be in your history. Yes? Okay.
There are two companies, one has a lot of hard assets, can borrow at a low rate, could collateralize against them. So it might be a smart thing.
Now, be very, in fact, the question was if you have hard assets, what did I say about the way I look at borrowing? Borrowing is based on, let me phrase it differently. Would you rather lend money to Google or GM? It's a no-brainer, right? GM has a lot of hard assets, but what the heck are you going to do with those hard assets? You're going to sell an assembly plant in Flint to whom? For real estate? Have you seen the prices of real estate in Flint? It's not hard assets versus soft assets. It's income generating assets versus non-income generating assets. And that's, I think, the key to recognize is, and I think the problem is accounting plants this in your head, right? If you have physical assets, you must be safer than if you have intangible assets. Almost a curse word in accounting. You have a lot of intangible assets. You're supposed to go hide behind a rock or something, I have intangible assets. But if you have intangible assets that generate cash flows, who cares? I'll lend against them. So it's not the hard assets per se that keeps the cost of debt It's because TCS makes a lot of money that's allowing you to borrow at a rate lower than you should be paying. Then I moved to Baidu. Yeah, successful company. You're the only search engine in China. You're going to make a lot of money, and they do. So I did exactly what I did for Tata Motors, and I looked at the cost of capital, and I borrow money, and the cost of capital drops until I get to 10%. And then it takes off. The optimal debt ratio is only 10%. You see, but it's a successful company. It's a money-making company. But it's 10% of what? The market value of the company. Remember, the debt ratios we're using are market values. You think, so what? If you're a growth company, think of what your market value looks like. It's a huge number, right? 10% of Facebook's market value is $20 billion in debt. And Facebook would have a tough time servicing $20 billion in debt. If you're growth companies, your optimals are going to be low, not because you're not successful, you're not making money, but you're not making enough money relative to your market value to be going out to 30, 40, 50% debt. In fact, Baidu's actual debt ratio is 5%. One more thing to remember, I'm going 0, 10, 20, 30. Your true optimal might be 8 or 12 or 13. So in a sense, by having these 10% increments, so what I'm saying is if your actual debt ratio is 7, the optimal is 10, don't do freakish things. You might already be at the optimal at 7, right? So this is really about direction. 7 versus 40, do something. 7 versus 10, I'm not sure there's much to do. So in this case, you look at Baidu and say, you know what, you're pretty close to where you should be. I'm moving on. So 4 different companies, 4 very different assessments. Let's finish the process by looking at Bookscape. Bookscape is a private bookstore, right? And here there's a mechanical problem in getting started. If you remember, the way I got my cost of capital table for Disney started was I added the market value of equity and the market value of debt to get a sense of what the value of the company was. See what the problem is going to be with Bookscape? There's no market value of equity, there's no market value of debt. So I'm going to cheat. I'm going to estimate a market value of equity. And I'm going to use a very simplistic rule. I'm going to take the net income that Bookscape has, which I should be able to get even though it's a private business. I'm going to multiply it by, I know this is very back of the envelope pricing, but I apply a P ratio. I get an estimated value for the equity of 31.5 million. You're saying that's simplistic. You're absolutely right. If I were valuing Bookscape, I'd do it a lot more carefully. But here I'm just using it as a starting number to come up with my debt ratio. That's my 31.5% equity. The debt they have is mostly lease debt, 12.136 million. So right now their debt ratio is about 28%. I'm going to do the cost of capital table for Bookscape. And really there's nothing that I have to do differently. The one thing that I did differently than I did for the other companies was I used the total beta. Why? Because there's an owner in the bookstore who's got all her money invested in the bookstore. So that's the only real difference is my total beta becomes my standard, which of course pushes up my cost of equity to every debt ratio. And if you look at the cost of capital is actually minimized at about a 30% debt ratio. They're at around 28%. Here again, you look at it and say, you know what? You're pretty close to where your optimal is. But here's the difference. If Bookscape were actually at 5% debt and they were at the optimal is 30%, I would hand the 30% to the owner, and if she said, look, I don't like to borrow money, it makes me uncomfortable, I'd say, fine, don't borrow money. The public company, you come up with a 5% debt ratio, and I hand you 30%. The manager says, I don't want to borrow money. Makes me uncomfortable. I said, take some ulcer medication and go borrow the money. The fact that it makes you uncomfortable is neither, you're paid a lot of money to be the CEO of a company. I'm not paying you to be comfortable. I'm paying you to do the best you can. You have a fiduciary responsibility to your stockholders. So if you run your own business, say, I don't like to borrow money. Don't borrow money. It's your company. But if you're the CEO of a company, it's not of a public company, it's not your company. You are an employee, a very highly paid, very powerful employee, but you're still an employee. You got to get over that discomfort and do what's right for the company, because you can't draw these lines in the sand saying, I don't borrow money. Debt makes me uncomfortable. So with Bookscape, that's something you got to factor in. So all of these, what did I do? I took the cost of capital approach and I looked for where the cost of capital is minimized. Time for some truth in advertising. So I'm going to look at the weak links in what I've done. First is, it is static, right? I've used last year's operating income or normalized to do all the analysis. Let's face it, income is actually in a distribution. I've used a single number. What I'm trying to do is lay the foundations for how you can make this better. So the first is it's static. Second, I am ignoring indirect bankruptcy costs. Do you see why? Because I've kept the operating income fixed as your rating went from AAA, AA, single A, triple B, double B. I said, no, nothing happens. And we know that that's not right. We know operating income itself could get impacted as your rating changes. And finally, I am making these assumptions that all of the market risk is borne by the equity investor. That's what the levered beta does. All three assumptions are fixable. In fact, the approach I'm going to lay out is called the enhanced cost of capital approach. It sounds fancy, but it's actually a tweak on the traditional cost. In fact, it's the same spreadsheet I'm going to send you. It does both the regular cost of capital and the enhanced approach. First, I am going to allow your operating income to be affected by your rating. What I mean by that is your operating income is actually going to decrease if your rating drops below triple B. Why? Because you drop below triple B, your customers might stop buying your products. How much it will drop will vary across businesses. In the grocery business, it might drop by only 5%, but if you're in the aircraft business, it might drop by 50%. So two things are now going to be changing. Your cost of capital will change as your debt ratio changes, and your operating income will change. Second, if I wanted to, remember we talked about Monte Carlo simulations when we did capital budgeting? You see how we could do this? It's kind of, it'll make your Excel spreadsheet incredibly sensitive. But rather than give you one operating income number, we are an oil company, what if I could put in a distribution of operating income, reflecting the fact that oil prices could go down to 20 or could go up to 80. You'll get a range of optimals, and you can say, you know what, I want to avoid distress, so therefore this is where I'm going to fall. So both are very easily incorporated into traditional capital structure, and here's how I did this for Disney. To incorporate the distress effect, I allowed three choices in the spreadsheet. Low is what you would pick if you had a grocery store, where dropping your rating affects you, but not by huge amounts. Medium is what I'd fix if you're not sure what you're doing. Kind of a generic company. And high is what I'd pick if I were doing a Boeing or I were doing a company with a rating effective. So it's actually a drop-down menu, low, medium, high. You pick one of those. I'll incorporate that into your operating income. I picked medium for Disney, and here's what I got for my optimal debt ratio. Remember the original optimal was 40%? Now I've incorporated the effect into my operating income, and what I'm looking to see is where my value as a company is maximized. You say, why aren't you focusing on the cost of capital? The reason I was able to focus just on the cost of capital in the original approach is I assumed that the numerator stayed fixed, the operating. Now that both the numerator and the denominator are changing, I have to look at the value of the company. You might actually have a scenario where your cost of capital decreases, but your value also drops because you're operating. I'll give you a caveat. The optimal stays at 40%. Look at the cliff. You hit about 45%, you start to flip what happens is you get into this unraveling. Your rating goes from A to double B to single B to triple C. It starts to feed on itself because remember, each time your rating drops, it pushes up the interest expense and pushes you down further. If I were advising Disney, I'd say stay away from 40%. It looks like the optimal. Stop at 30. Build yourself a buffer. You don't want to get close to that cliff because if you fall off the cliff, you're not going to be able to climb back up again. So when you get the spreadsheet, try that. Pick the bankruptcy cost, see what it does. For some of you, the optimal might not change. For some of you, the optimal might change substantially once you incorporate the bankruptcy cost, but bringing it in. We've looked at 5 companies, right? One company we haven't looked at is Deutsche Bank. Before I even talk about the optimal debt ratio for Deutsche Bank, let me reframe the question. Remember we said for banks, there's no such thing as debt. Debt is really raw material that you use. But you also read constantly about banks being undercapitalized, right? I mean, it's big news now. Citi is undercapitalized, JP Morgan, every European bank is undercapitalized. What does it mean? It's not about having too much debt, it's about having too little equity. And too little equity defined in a very specific way. When the Fed talks about a bank being undercapitalized, they're not saying your market value of equity is too low. They're saying your regulatory equity, the equity that we call Tier 1, Tier 2, Tier 3, has dropped below where it should be. I'm going to use that to reframe the way I think about what a bank should do. So a bank comes to me and says, Well, we're thinking about growing. What should we do? Okay, you're thinking about growing. You're going to increase your regulatory capital. How much? It depends on whether you start off as an undercapitalized bank or as an overcapitalized bank. So everything then rests on what do you want your regulatory capital ratio to be. So let's do a very simple example. Okay? Let's assume you have an old-fashioned bank. You know what the old-fashioned banks used to do? You'd go in and deposit money. They'd pay you 5%. They'd take that money, lend it out at 6% and make money on the spread. That's old-fashioned banking. That's how the Rothschilds built banking in Europe. Basically borrow and lend at a higher rate, the spread. So this is an old-fashioned bank. It has made $100 million. So these are loans that the bank has made, 100 million loans, and its book value of equity is $6 million. I'm going to use a very, very, very rough measure of regulatory capital. I'm just going to divide the 6 by the 100 and say that right now, that they have a 6% regulatory capital ratio. The bare minimum, the regulatory base is 5%. So they're actually got a buffer. They're at 6. But they're a conservative bank. They're looking at all these crises and saying, we want to raise the regulatory capital ratio. Remember that banks have been around 700 years. Regulatory capital ratios have been around only since the Great Depression. You know what that tells you, right? Sensible banks have always maintained regulatory capital ratios because they want to survive. It's not about meeting a central banking requirement. So what I'm saying is regulatory capital provides a floor, but it doesn't have to be a ceiling. A conservative bank can set a ratio above that. There's a price you pay for doing that. So let's say this bank says, we're going to both grow our loans from 100 to 150 million, and we want to increase our regulatory capital from 6% to 7%. So right now they have 6 million in equity, right? That's 6% of the 100 million. Next year they're going to have 150 million loans outstanding. They want to have 7% of that in equity. So 7% of 150 million is 10.5 million. So their regulatory equity has to increase by 4.5 million. How does a bank's regulatory equity, how do they increase it? What are the places they can go to try to increase the regulatory? What's the first place they can look? Retained earnings, right? And retained earnings is affected both by how much money they make and what they pay out in dividends. So already you can see the foundations for assessing dividend policy at a bank. If this bank is making 5 million in net income, and they're asking how much should we pay in dividends next year? Sounds incredibly simplistic, but how much should they pay in dividends next year? They can pay $500,000, but say we always paid 40%. Hey, you want to pay 40%, then scale back your growth expectations. Or you can't have your cake and eat it too. Actually, they do, and somebody else pays for it. Because if you paid $3 million in dividends and you have only $2 million in retained earnings, you now have to come up with $2.5 million more. So what's the second place you can go? You can issue equity, right? Which is kind of silly because you just paid a dividend and you issue, but for some reason banks seem to continue to do that. But you can issue equity, or you can issue what regulators think of as equity, which might be preferred stock. But you either have to use retained earnings or you have to raise fresh equity to get the 4.5 million. For banks, that's all capital structure becomes, is what's our regulatory capital right now? What do we need it to be? And that can be a function both of what's happening within the bank and outside, right? Because if the rules are changing, as they are right now for capital ratios, you've got to factor that in. Not just in terms of how much new equity do you raise, but how much you pay in dividends and what your plans are for growth. All have to be adjusted, reflecting those expectations. So here's a messier example. I tried this for Deutsche. Almost every bank, if you go look at their annual report and their financial statements, will tell you their regulatory capital ratios. In fact, if you go to Capital IQ, you can pull down the Tier 1, Tier 2, Tier 3 capital for every bank. This is what Deutsche looked like when I started the assessment. They were losing money, and their regulatory capital, this is the Tier 1 capital, is 15.13%. The way regulatory capital ratios are defined is as a percentage of risk-adjusted regulatory assets. You know, it's incredibly messy. But it turns out that it's not that different. If you take book equity and risk-adjusted regulatory assets, there's almost 94% correlation. There's little adjustments you've got to make. But you almost never would see a bank with risk-adjusted regulatory assets that just takes off. So in this case, basically the Tier 1 capital ratio is 15.13%. let's assume, and this was actually in Deutsche's own plans, that they want to raise that ratio to 18%. So they've told you that half of the equation. Let's also assume that you think that net income is going to recover. That the return equity, which right now is negative, is going to converge on about 8%. Here's what I did. I first projected the return equity and the net income. Then I projected out how much the Tier 1 capital ratio would look like each year, given the amount they paid in dividends and what they retained. And that then becomes the basis for deciding how much new capital they will have to raise, how much they can afford to pay in dividends. But effectively for financial service companies, here's the bad news. If your job is asking, does my insurance company, does my investment bank, does my bank have enough equity to answer that question, you have to start understanding regulatory capital. I'll make a confession. Until 6 years ago, you couldn't have paid me enough money to open that Basel capital book and read through the crap that you got to read through, the hundreds and hundreds of pages of bankers dancing on the top of a pin. But the reality is, if you want to work with banks, value banks, assess banks, you have to do that dirty work of assessing how the rules are written. So if you think about the strategy you can adopt as a bank, here are the three choices. You can go with what I call the regulatory minimum, which is you try to get as close as you can to the minimum and hope that nothing bad happens. You think of this as a game, which is, hey, the regulatory authorities have a ratio. If I can look like I'm meeting it, then everything's okay. And you're forgetting banking 101, which is you can keep the regulators happy and go bankrupt at the same time because you did all the stupid things. Second is there's a self-regulatory strategy. You say, look, I'm a bank. I want to survive as a bank. I'm going to find the regulatory capital I will need to survive. So you look at your loans, you look at the risk in the loans, you want to make sure you've set aside enough equity to cover the downside. And finally, there's a combination where you look at the minimum and you set your base. And that's where most banks end up. And that's why you can have conservative banks and aggressive banks. Conservative banks being ones that build enough buffer in there, and aggressive banks being ones that don't. So we've looked at a whole range, and what I'm going to do is I'm going to send you the capital structure spreadsheet. What I'd like you to do is put in the numbers for your company into the spreadsheet. It's very straightforward, 9 inputs. It'll take you all of 15 minutes to do, I promise, 15 minutes. And in the process, here's the rest of the stuff you're going to find out. You're going to come up with the costed capital for your company, which was in part 4. You have a return on capital in your company, which is part 5. You're going to get a bottom-up beta. You're going to get all those pieces. It'll capitalize leases for you as you go along. So all that stuff you haven't even looked at will get done in the process. You'll climb the ladder to number 93. Whether you come back down the snake is up to you. Okay? something is going to kick in and force you to reassess. What do you do? Okay, fine. Then you can use it. Okay, please go ahead.
I just have a question.
That's the street.
Oh, okay.
So basically, tap into the street.
Oh, okay, that makes more sense.
So basically, what I'm saying is, once you get past the street rate, then you're talking about high growth. I'm in a two-stage model. So I'm using the perpetual growth model right to the street rate. So I can't go any further. The street rate in a sense is a proxy of normal growth rate.
Awesome. Thank you very much.
I have a question about exam paper.
Yeah.
Here at over, so here is the tax is
Where's the tax savings from depreciation?
there. Yeah.
Why is your paying value?
Because I don't assume zero establish value. Because the civic value assume after 10 years it's zero, but it assume it to be a 100.
Where's the tax benefit? That's what the tax question is. Where's the tax benefit from the fact that you throw away something with a book value, you get a tax loss?
Oh.
You see what I'm saying?
Oh, got it. So
It's,
if for the the tax benefit from the
So basically, if you assume
Got
it
it.
has a value of zero, that's the consequences. You have to show that.
got it.
So you have to show that. So even
Got
though you
it,
don't
got
get
it.
it.
So, but it's normally we use like the same civic value.
We do that because it takes away the tax issue.
Oh,
If you
okay.
don't, if you set it at any other number, that's okay. But then you bring in the tax issue.
Got it. Thank you.
Hey,
Hi, Chris. Nice to meet you. So I sent you an email last week about potentially talking about the project car case.
Mhm.
We had made a basically a mistake.
yeah. So what do you do? Tell me what you did.
Okay, so basically what we
You
did.
had an 8.5 or 8? Okay. So you had the 3A and the 9B.
Yes. Yes. Wow.
So, which is a hockey class.
Okay, this is good odds.
So the 3A. So which part did you have the issue? 3A or 9B?
So the part with I don't remember which was
The
which.
3A
but
was the one you told me that because of when
The
you started
production.
the capacity, you got a year 10.
Yes, exactly. So our
And-
cash, so basically, yeah, the time that we got our cash back on that investment, or the equivalent of the cash investment, was in year 10, because we started at the 40% capacity in year 1 instead of year 0.
Oh, okay.
And it so it basically aligned, and it looked like,
So you did the year 10, but then you noticed it was in year 10 when the project ended, so that's why it's not in year 9. So I'll do that. Cool.
okay.
So just send me another email, just remind me to do it.
Okay.
Professor.
Hi, how are you?
Good, how are you?
Good.
Two questions. Maybe we could have gone to the TAs with it, but they're not really covered in the book. So,
Yeah.
getting a marginal tax rate when I have statutory and effective rate for my company. Use a statutory rate. Okay. What if they're
That's what I
like,
did, that's what it's like.
okay. But what if there's like long-lasting tax benefits? The reason why
That
there's
shit doesn't